Hello, everyone. It's Nick Hopwood, and I'm here along with
Jim Pilat.
and Jim. Thanks for joining here today, talking about a market update. How bad has the market been this year? There's really no sugarcoating it, is there?
No, it's felt really painful, no doubt.
So it's been bad, and over the last few weeks, the market seemingly has been going down every single day. It makes us wonder if we're doing the right thing at the right time. But I remind everyone that it's important to focus on what we can control. And part of our job is behavioral finance, which means helping people make good decisions and avoid making bad decisions at the wrong time. So we have a time-tested process and our plan, and we need to trust the plan. Bo Schembechler once said, the team, the team, the team. And now I like to say, trust the plan, the plan, the plan. So making good decisions and following the plan can sometimes lead to negative outcomes, but usually we think about that in the short run. But over time, we believe that they will lead to positive outcomes. So Jim, we know the market has volatility, but to get the average market return of 8 to 10%, what do we have to do?
Yeah, I mean, it's not always smooth sailing, right? There's going to be tough market conditions, like we've experienced now. We see it time and time again. We just need to remind ourselves that it's part of the investment experience. I think it's times like this where behavior and emotion really does start to steer our thought process, and we really need to kind of refocus back on, these time-tested principles.
Agreed. Let's take a look at some charts, shall we? All right. Now, these numbers might be a little small, but we're going to walk you through it. So a lot of our clients, a lot of investors out there are not aggressive investors, but they're not necessarily conservative either. They find themselves in the middle. This is why we focus a lot on risk and recommending the appropriate portfolio based on your risk tolerance. And a lot of people find themselves right in the middle, which we call a balanced portfolio. And oftentimes that leads to a 60-40 mix of 60% in stocks and 40% in bonds. And typically the bonds, they provide the diversification benefit for when stocks are ugly. So when stocks go down, oftentimes bonds go up. And so far this year, that really hasn't happened, has it?
It really hasn't, and it's unusual, and it's painful, and it's frustrating, and it's like you said, a lot of the second guessing comes from, right, because it's just not acting how it typically would expect to see it.
In fact, so far this year, stocks has been at a low of last week of down 25% from the recent highs, and bonds have been down as of last week 15% from the recent highs. Only 2008 has been worse for a balanced portfolio. And as you can see on this chart, here is 2022, and here is the performance of an indexed balanced portfolio. And you can see there is some negative back in 2018. And then here it is in 2008, which was a little bit worse than 22 so far. But in the prior years, going back decades, a balanced portfolio was really doing a great job of mitigating risk because bonds were doing a great job when stocks were down. So let's take a little more close look at bonds specifically. As you can see, we have a similar type chart where there's a lot of blue bars here, a lot of good years, and then a few red, and then here we are in 22. In fact, as I mentioned a moment ago, at the low point of the year so far, which was last week, bonds were down approximately 15% from the high. So this goes back to 1976, right? And the chart, the title says this could be the worst year for bonds ever. So Jim, what is causing this negative performance for bonds?
Yeah, I think the biggest driver of it is inflation. We talk about the high inflation, and the Federal Reserve, in order to try to tame that inflation, has been raising rates aggressively all year. And when they raise the interest rates, then the price of the bonds fall. And I think that's what that chart does a good job illustrating.
It sure does. Now, one thing that we have coming up are midterm elections. So they're about a month away. And we want to highlight this chart here. Historically, in midterm years, stocks have not done very well in the first 3 quarters of the year, which is exactly where we find ourselves right now. In fact, midterm years tend to see the largest intra-year pullbacks compared to other years of the cycle. The average intra-year decline in a midterm election year is 17%. And now, so far, we've seen minus 25%, so worse than average. However, once the election is over, we've seen the S&P 500 up the next 12 months every single time since World War II, and it's been nice returns of 14.1% on average. And this shows each midterm election year. See, none of the following 12 months after the midterm election were negative, and the average comes out to 14.1%. So I tend not to be a follower of the seasonal investment trends like sell in May and go away, but I think there might be something to this midterm statistic here.
Yeah, I would agree. I think there's a lot of reasons beyond just the time of the year for it to go up after the midterm election.
Absolutely. Okay, Jim, let's talk about bear markets a little more and what a recovery might look like. So we know since 1956, bear markets on average lasted about 12 months. Now, it does make a difference if we're in a recession or no. So in a recession, they typically last longer, 18 months. But if there's no recession, on average, only 7 months. Furthermore, the average drawdown for bear markets is 30%. So if we're going with these averages, 12 months until you bottom out at a 30% drop. And so far, we've seen 9 months and a 25% decline.
Yeah.
So
we're in that ballpark.
We're in the ballpark, right? Now, I'm on record flipping back and forth on whether we're in a recession. Okay. In fact, the first 2 quarters, we had negative GDP, which has always been the traditional definition of recession. But now for the 3rd quarter, it's looking like we might be positive by a couple of percent, which was definitely a surprise. And we're still having strong jobs numbers. So those data points point to no recession. But with the Fed hiking so aggressively, right, it could be that we're just slowing down right now and that we have a recession next year. We just don't know. But what we do know is that it's already been 9 months and the average is 12. And we've already seen a decline of 25% and the average is 30. What about recovery?
Yeah, I think it's interesting to see the length of recovery associated with these bear markets. And you can see, again, on average, for all bear markets, we're looking at 19 months for a full recovery. In the recession, again, it's a little further out to 27 months. But if you take an average without the recession, 10 months. So we've kind of gone back and forth as to whether or not we're actually in a recession. And maybe we are in a recession, but maybe it's going to be a mild recession because of some of the mixed indicators we're getting and pent up demand to spend and things like that. So, it's looking like, maybe somewhere in that 18-month range could be, 18 to 20 months could be a reasonable estimate.
And let's look at the last 2 major recessions, 2000, 2002, 2008. Right. These were major drawdowns with much longer recoveries. So these definitely, have an impact on the averages down here at minus 30 and 19 months. So we just want to highlight where we are, some of these statistics about stocks and bonds, bear markets, midterm election years. And we thank you for watching today. And if you'd like to schedule time, please call the office or visit the website and you can book online at peakwm.com. We're happy to have a conversation with you about the portfolio and your plan. Trust the plan. Understanding how this bear market has affected your long-term planning is a very good place to start. We appreciate the trust and confidence that you have in our work, and we'll talk soon.